Hello, and thank you for joining on the latest in our Dolfin Discussions video series, where today we have our very special guest, our very good friend, Dumas. He is the chief economist with TS Lombard and has been one of the most highly respected economists on the street since he began his career back in the 1970s. What I've asked Charles to do today is to help us to unpack one of the most perplexing questions that I have at the moment, which is this apparent disconnect that seems to be in the world between macroeconomic and fundamental data and what we're seeing price-wise in risky assets. So this strikes me as sort of hard to square, and it opens up a lot of other questions as to what is going on in the world. But in essence, what I'm trying to do is to make sense of data that, quite frankly, doesn't make sense to me. So I'm gonna start it off and just ask you point blank, Charles. Just dive right in. So risk assets, equities in particular, they sold off extremely abruptly and sharply, particularly from the announcement that the coronavirus had really taken hold in Italy. But then they bounced. And they've held that bounce since then. And this is despite some really troubling data on the economic and the fundamental side. Do these risk asset prices make sense?
Well, I'm bound to say that my short answer to that is no. But on the other hand, the market is always right and the market is always wrong. So one has to remember that and to work out why it is that it's right and why it is that it's wrong at any one time. And the basic point here is that the market has a tendency to want to focus on one thing. So, you know, a couple of years ago, it was trade war. And the ups and downs of the trade war were driving prices regardless of the ultimate prospects for the economy. And now it is coronavirus and COVID-19. And so the ups and downs of the medical story, which is essentially what it is, are tending to drive the market. So what have we got? Well, what we've got is that as a result of the lockdowns, quite a lot of suppression of the disease has taken place. And as a result, we're beginning to see relaxation of the lockdowns. And the result is that the catastrophic drop in April sales and April activity in general is something that is likely to be modified even in May and June, and certainly in the third and fourth quarters. And so people are basically saying, well, that problem's sort of going out of the way, so let's assume that everything's going to be all right. And so we're at a level of about just over 2,900 on the S&P, which is still down more than 10% from the peak in the middle of February. And maybe that just reflects reasonable assessment of prospects. Now, we think that that's absolutely not true, because the actual problems the market is going to have to deal with are very serious indeed and amount to a typical recession. Specifically, although of course we think that GDP will probably revive a little bit in the third quarter, that's because it's going down so much in the second quarter. So basically we think that the second quarter GDP is going to be down just short of 8% in the United States from the fourth quarter level. And yeah, it may recover a bit, but it's going to be recovering at rates of about 2% a quarter maximum thereafter. So maybe an 8% annual rate in the third quarter and a sort of 4% annual rate in the fourth quarter. So you don't really get back to fourth quarter 2019 levels of output until sometime in 2022.
What about this tremendous suffer we've gotten out of governments and central banks? So has that has that taken some of this downside away and given us more of the V shape that a lot of people are talking about, as opposed to kind of I don't know, maybe a swoosh or a tick mark shape that you're talking about?
Well, no, I don't think it does, because the basic thrust of policy is protective. So fiscal policy is protective and needs to be protective, I should add, because there is no doubt that when it comes to the point in Western society, we don't automatically rescue firms which are in trouble. And therefore, credit measures and monetary measures are not by themselves enough. There needs to be fiscal stimulus and fiscal support for firms that are stressed. And there is, and that's good. But all I'm saying is that to get growth, you actually need people to go out there and spend money, which right now they're not spending. And what we think is that the average consumer is going to be very inhibited about all of this, and that people, you know, even if you're wearing a mask, are you really going to want to go to the theatre? Do you really want to go to sports events? Do you really want even to go to a restaurant? Bearing in mind that if they're going to keep everyone 2 foot away from everyone, sorry, 2 yards away from everyone else, they're going to have to have a much less dense occupation of the rooms in a restaurant, and therefore, by definition, quite a lot higher prices. And do you want to go to a bar? Well, you know, of course you want to go to a bar, but the question is, how keen are you going to be to go to a bar and exchange breaths, so to speak, with a bunch of people who might be infecting you? So that's the basic problem here. People are going to be very inhibited. And there's no guarantee that there's going to be some sort of vaccine. There may be a vaccine, and I hope there is a vaccine. But so we don't know that there's going to be a vaccine. And even if there is a vaccine, these little diseases have a way of mutating in such a way as to keep one jump ahead of the vaccine. So we don't even know that this is a soluble problem, nor do we know that the solution, if we develop one, is going to work.
So I take your point, and it's interesting. You talk about people who want to go to a bar. Boy, oh boy, I have a 1-year-old and a 3-year-old, and I can't wait to get to a bar.
Well, of course, and you know, I'm the same. I mean, as one of the Irish writers said last week, he said, "We're all going to be drunks unless they open the pubs."
That's probably true. Hopefully I'll be okay. But yeah, I take that point very, very well. But let's talk about the inhibitory effects of not just of the lockdown, but also of personal behavior post-lockdown. And here I'm sort of brought to mind in thinking about the pace of the economic recovery in places like China, Singapore, South Korea. Then as we migrate westward, into Europe, where there's been a lot of variation in how policies have been deployed. And then we move over to the US. And I'll give you sort of my sort of armchair / bird's eye view. The Chinese were first, and they were extremely aggressive in implementing a lockdown that I don't think anybody in the West could possibly mimic. And with all the usual caveats about the quality of Chinese data, it appears that they've got it under control. So now you have a Chinese recovery path. Then you've got some other recovery paths here. You've got Singapore, which has, I think, done pretty well. South Korea, which has done pretty well. And as we migrate westward into Western Europe, you've had varying degrees of aggressive lockdowns with varying degrees of economic sort of damage done. Although the case of Sweden suggests that the economic damage is more consistent regardless of what that lockdown might have been. I am wondering if either of those broad buckets, the Asian experience, the European experience, gives us much indication for basically the most important consumer in the world, the Americans. The policy response in the United States looks a bit disjointed and haphazard. We're going to come out of this lockdown with some pattern of consumer demand. Yes, they're maybe not going to be rushing into the theater. what do we know about the way economies have recovered given lockdown in Asia, the way economies appear to be responding given lockdown in Europe now that they're unlocking, and how does that tell us what the growth path is going to look like for the US?
Well, first of all, I should say that we have a pretty good China service, and I'm not here to advertise that, but I might as well mention it. And our commentary on China says that, as a matter of fact, the consumer reaction there is pretty much straight along the lines I've just described, which is pretty inhibited, to say the least. And the Chinese reason why we think that there will be significant recovery in China is because they are doing something which in the West we remain inhibited about, which is that we're not just running Keynesian deficits in China, they're also actually spending money on infrastructure. And of course, it's going to be on property and construction when they find that what they're doing is not enough to achieve what they want. So that's one thing to bear in mind. Another thing to bear in mind is that the Chinese real GDP, on our recalculation of it, which I might say tends to emphasize or create the existence of a cycle which the Chinese data tend to deny, on our recalculation, it fell by 12% in the first quarter. And when I say 12%, I mean 40% annual rate in American terms. So
that's Q on Q.
Yeah, that's quarter on quarter. And when you've got reductions, you don't multiply by 4, you multiply by a bit less than 4. So that's just the funny thing about statistics.
It's just math.
But yeah, exactly. But 12% is the crude quarterly number. You know, the US was down 4.8% annual rate in the first quarter, which is 1.25%. We're expecting a significant 23% annual rate of decline in the second quarter, at which point, as I say, it'll be nearly 8% down from the fourth quarter of last year. And in Europe, it's worse for a variety of reasons. But essentially, I think the main point here is that this idea that somehow they've solved the problem in China is wide of the mark. It's not that they're not doing a pretty good job. It's just that the job is monumental, and getting around people's inhibitions is the main issue here. And
we have our man on the ground is actually my colleague, and she tells me that Chinese luxury goods demand has rebounded quite sharply.
Well, that I'm quite prepared to believe, but luxury goods are bought by well-off people. I'm just talking about the overall aggregates. Of course, it's perfectly true that, that China will recover, and that in due course, we will work out new ways of associating with one another. And that's really what it's about here, is that society is going to be changed in a fundamental kind of way in terms of literally society, how we socialize. And that's yet to be worked out. And of course, it will depend very much on whether or not a good vaccine is developed, a vaccine. And so, you know, coming to the point, to Europe, the position is significantly worse than the United States, because Europe has a fundamental deficiency of demand and also a massive divergence in performance within the Eurozone, particularly between most obviously Germany and Italy, but also in a more general sense, the north center, the so to speak, so-called core, and the Mediterranean countries. And so onto those divisions is imposed this very difficult problem. And the fact that, as a matter of fact, the COVID-19 experience has been worse in Italy and Spain than it has been in Germany in particular, but also to some degree France and certainly the UK too. So, one way and another, they're all in a lot of difficulties. And the Germans, who in GDP terms have done a little bit better in the first quarter at least, are facing the fact that their most powerful source of growth has typically been exports, and the exports have, in terms of growth, largely been to China and the emerging markets. The emerging markets are really in very substantial difficulties. It varies enormously by country, of course, and this whole idea of BRICS is a little bit of a misnomer because you know, India and Brazil maybe don't have quite so much in common as you might imagine. The only thing they've really got in common is that they're substantially poorer than us. And so that's why they are referred to as emerging markets. But the basic point here is that there are a very large number of emerging markets which are in quite serious difficulties, Brazil being one of them.
You see, so you brought up sort of two, sorry, I apologize for interrupting, but you brought up sort of two questions which I really want to try to dig into. You talked about Europe and the way that Europe has performed and the way that Europe struggled a bit relative to the US. And I think you're absolutely correct to talk about some of the issues that predate the COVID recession. So north-south discrepancy in European performance, the dependence on particularly exports to China for Germany in particular. You also brought up markets, and that's really also something that I'm very focused on. Before we go too far away from Europe, and knowing that I want to return to EM, a lot of the recovery in the equity markets has been about basically a handful of mega-cap US tech stocks. So there's this sort of very short little basket, the Amazons and the Googles and the Microsofts, that have just done extraordinarily well in the United States. And after that, it's kind of a cliff. Europe has lagged quite a lot. Do we see the opportunity now that Europe appears to be coming out of lockdown with the virus under control, despite some of the economic baggage that they're carrying, and you've mentioned this baggage, do we see an opportunity for a reversion here? European risk assets perhaps catching up with the US, or maybe the US catching down with Europe, whichever direction?
Well, I think it's more likely to be the second of those, I'm afraid. Basic view is that the US earnings this year are going to be down 25%, and that's really the most modest version. And although next year they should recover, we don't see them recovering to anything like the level of 2019. So fundamentally, if you look at the S&P earnings in relation to the index, the earnings level in 2019 was 160. And that's a sort of high-ish number, but we'll call it 160. So we're saying it's down to 120. Now, as we see it, the long-run average forward PE has been around 18 times. And you know, that means that, and in bad patches, it's averaged 16 times. In other words, worse than the long-run average. And in fact, if you go back to 2008, there was one moment when the forward PE ratio was about 12 times. So, you know, it just shows you how low, how random things are. So what are we talking about? Well, if you take 16 times 120, which is down 25% from 160, you get to 1920, which is below 2000. So as far as I'm concerned, it's the US which is mispriced. And in particular, of course, the FANGs and the guys you referred to, the tech stocks, which have been swarming up. And one gathers that there's a whole heap of sort of personal, small investor interest, which has been behind some of this surge. And I'm afraid it's an embarrassing fact that the sort of small personal sector tends to, personal buyer or holder of stocks tends to get out at the bottom and to sell at the top and to buy at the top. In other words, they get it wrong. And they get it because they work on what's past rather than what's future. Saying here is that no, you can look at earnings next year and it could be up on that 120 number. We think that the increase is going to be less than 10%. So you'll only get to about 130 next year. But the market actual earnings forecast is 142. It's up 18%. But even so, if you allow for the discounted forward PEs that one uses for a year and a half future, you still end up with below 2,000 for the stock market. So we stick with our number. And so in response to your point about Europe, I guess I'd say that the markets there have rightly been held back by the fact they don't have all this tech stuff, which is obviously the wave of the future. But it may well be that the conformity, the convergence will be US converging on Europe rather than the other way around.
That's very interesting. And I have to say, I think you're right. This goes back to the conversation we had where I was asking you point blank, how do you make sense of this fundamental data if the data doesn't make sense? And I just can't really get comfortable with the idea that the U.S. markets are appropriately pricing the earnings expectations. So one possible explanation is the concentration we've been talking about. Another explanation, which I think has a lot of weight in this context, is the tendency for individual investors to get the timing wrong and to be trading through the rear view mirror. And in the United States markets, that's particularly important. I mean, there's just more of a 401k culture there.
Yeah.
Here in Europe.
So I sort of go back in some ways to the tech bust back in 2002.
Yeah.
Because to my mind, that was the model for any tech bust, really. And what happened, of course, was that the big downswing occurred between about August 2000 and February 2001. And that was when the main shakeout occurred. It was a little bit of a bounce. And then we had 9/11, of course, in September, and that sent things back down again. And then there was a bounce out of that. Then in the first half of 2002, there was a big bear patch. And it came a year and a half after the main bear patch. And the point I'm driving at here is that the sort of euphoria tends to get blown out of people by in waves of pain, to be quite frank. And that's probably what we're going to see.
Well, one of the things that I've been pointing out to clients is that so it's very natural. I mean, generals are always fighting the last war. Investors are always trading the last recession. It's just normal. It's the way people work. And one of the things that I'm trying to point out to clients is that if we look back at the 2008 recession, we're all very focused on this really sharp sell-off that we saw in the second half and the third quarter, basically. But what people forget is that we had already seen a 30% decline in equity markets in the months leading up to it. We were already taking on board the reality of the popping of the mortgage bubble, of the Bear Stearns down, the whole recession that was unfolding. And it was only in the failure of TARP to pass that initial vote through Congress in the US that we saw that capitulation trade. What I find rather sort of surprising in this current market is that we got the capitulation trade, we got the bounce, but we still haven't seen the preliminary sell-off as people are starting to become aware of the economic consequences. And we haven't seen the following sell-off as people take into account that newly unemployed take time to get back into the job market, that financial pressures on firms means bankruptcies, means a tightening of credit, means it takes time for firms to recapitalize and return to full operation.
Yeah, well, I've got to say, I don't think that initial downswing of the market between mid-February and mid-March was a capitulation trade at all. I think it was just a sheer shock, actually. And capitulation is yet to come. And that'll be when we hit the low. But in the meantime, we've got the fact that, if you look at the consumer confidence surveys, you find that the expectation of people is that they're all going to be back in jobs, but not so good on wages in about 6 months' time. Well, a lot of those people are not going to be back in jobs because the jobs they should be going back to won't be there. They won't reopen those. In Britain, I don't know what the data are like in the United States, but in Britain, we're reading stories that half the pubs won't reopen. Well, if half the pubs don't reopen, people aren't going to be able to go down to the pub and drink so much.
I know, and in our case in particular, I think that's a really disturbing statistic to hear. I'm quite worried. But one of the questions that has kind of come to mind, and this goes back to the comment or the question I was sort of fielding before about the different economic trajectories and the different policy responses. And this is at a very high level. In Europe, you see more examples of governments using fiscal stimulus via paying firms not to fire people. We will help you to meet your wage bill temporarily so that you can keep your head above water, and this will work.
Yeah.
In the US, it's a very, very different approach. In the US, it's generally, we'll backstop your credit. So if you want to add your leverage, you can add leverage, even though you're already, the US corporate space is extremely highly leveraged. And we'll write checks to the newly unemployed, which creates a really perverse set of incentives. In the case of Europe or the UK, you have an incentive to keep the job where it is, and fingers crossed, things start to reopen, perhaps not at the pubs, but down at the plant. You bring those same people back on, so the job is sort of retained. In the US, you have every incentive to just let them go. They're off your books.
Yeah, well, and I think that is a fair point. I do actually think that the US recession will be less severe than the European recession because of the points I was making earlier about the disparity between various European countries. But you also said you wanted to talk about emerging markets. And
I did, and thank you for bringing it back. I really appreciate it.
I've got to say that, one of the things that worries us most is that a lot of these emerging markets are sitting there. And if you look at one of my charts on the world balance of payments, I can't remember which one it is.
Let me find it for you. I'll find it. You keep talking and I'll handle it.
Anyway, if you look at the chart on the world
current account balances.
Yeah, that's it. Current account balance. I mean, the interesting thing is that the big surplus countries are Europe, obviously Japan, no longer China, but until recently oil companies. And the big deficits have not just been in the United States, which we all know about, and in the sort of Anglosphere outside the United States, which is sort of like Britain, Canada, Australia, and so on, but also in the non-oil emerging markets. Guys have huge debts in dollars, and the dollar's been going up particularly strongly against emerging market currencies. And those, so I think we're going to see a lot of people actually necessarily defaulting on some of those loans, and when they do, it's going to roil up the banks big time. And I'm talking much more about European banks really than US banks, because although US banks have a lot of exposure to Latino land, if you're looking at the countries which could be in trouble, I mean, most obvious candidate up front is Turkey, and that's going to be banks and Spanish banks. And banks are a much more important part of the stock market in Europe than they are in the United States. So you're already in a position where it sort of justifies the underperformance of the European stocks. So I think we've got a lot of trouble coming down the pike as sort of knock-on effects of this whole thing, including obviously unemployment in the West and much lesser capex, which we haven't even started to reckon with yet.
Yeah, I think you're absolutely right, and we haven't talked about what I would say are sort of the more traditional drivers of a recession. So typically, the way I sort of think of a recession kind of panning out is you get the cyclicality induced in activity that's to a great extent driven by capex, which gets curtailed, and instead sort of ripples throughout the economy, and then over time the capital overhang gets sweated off. I'm glad that we got a chance to come back to current account balances, because I actually have memory of the peso crisis in the U.S. and Citibank, and I don't know if we're looking at something like that again. But when I sit there and I talk to clients and I talk internally to my colleagues, and we discuss what's going to be the catalyst for the next leg down, and I want to point out that you've already said we haven't had the capitulation trade yet, which I think is a really interesting point. Potentially, the catalyst for the next leg down is an EM debt crisis that shows up on the balance sheet of a bank we care about. So on the one hand, I think there's been a lot of work that's been done by the ECB and by the Fed to try and solidify these bank balance sheets and to protect the infrastructure, the pipes that help to keep the system running. But at the end of the day, if somebody bigger than Argentina says, nope, just not going to pay it, that's a problem.
Yeah, yeah. Well, I just think that we're going to see. I mean, there's an element here of sort of psychological pressure, to put it mildly. I mean, the reality is that the real trade is, do you kill off more poor people in emerging markets in order to make sure that they can repay their debts? And the short answer is going to be, no, you don't. So I'm afraid that part of financial pressure is likely to bounce back. And the question of which countries have got a real grip on the medical aspects of the situation is going to be very important. And of course, that is something which varies enormously between country and country.
Yeah, Charles, I'm conscious of the fact that we're going to run out of time at a certain point, and there's one more. There's a whole list of questions I'd like to ask you, but there's one more in particular. I know you've written quite eloquently in the past on the issue of populism and how that's fed into sort of the political and the economic backdrop. And as I look around today, it feels like this shrill populist rhetoric has gone up a notch at a moment where, traditionally you would expect the experts, so to speak, to be stepping in. Instead, they've been pushed further to the background, particularly in certain countries. What do you think the implications are for the macro political economy in the coming years?
Well, I mean, the big story obviously is US and China, and that's going to play out during your elections later this year. So the question of whether or not people will turn out to vote on grounds of hostility towards China, or sort of a big battle about who's number one, which seems to be what's taking place to some extent beneath the surface of each particular issue. You've had the trade war, now you've got COVID-19, and one way or another, there's plenty to talk about. But then you've also got a sort of a minor league version of all of this in Europe too, where, for example, for 20 years now, the Germans have restrained their incomes and become very competitive cost-wise. But as a result, of course, the average German has actually had very much less increase of real spending power than his product. So he hasn't been paid for what he's done, to put it bluntly. And needless to say, they don't blame it on themselves or on their own government. They blame it on the Euro system and the ECB and the negative interest rates, which of course represent a sort of backdoor transfer from people who save, which is AKA Germans, to people who spend, AKA Italians and Spanish. So, one way and another, there's plenty of scope for resentment to build up in the European context and to reinforce this disintegration, which is, I think, the main theme really that emerges from all of this. And if you think of globalization as having been behind some of the great wealth creation of the last 30 years, really, since all of the of communism, you have to reckon that fragmentation is going to take us the other way.
Yeah, I think that's right. And it's one of the it's slightly depressing. One of the points I try to make is that in the world of economics, where it can be very difficult to say anything with absolute certainty. I mean, it's there's quite a lot of art to this social science. One of the most robust results we've ever had is increased trade and free trade, and globalization results in higher incomes. It may result in other things we don't like, perhaps, but the impact on is pretty clear. And I think you're right. The fragmentation is going to be an issue, and that's not a very nice harbinger for what the future holds. Charles, I have to say, it's been really, really enjoyable having this this chance to catch up with you and to talk. I can't say it leaves me, the most optimistic that I've ever been, but perhaps a dose of realism is what we need right now.
Yeah, well, thank you very much, James. It's always good to discuss these issues, and if we get them out in front, then maybe we can start moving towards a solution.
Absolutely. So thank you again, Charles, and for all of our clients who have taken the time. We're very grateful. As always, if you have any questions or comments, please feel free to reach out and to send us an email. You can reach us at marketing@dolfin.com. And I look forward to inviting you to our next episode of Dolfin Discussions. Thank you.